Okay, welcome everybody to episode 54 of the Volatility Barometer podcast. So thank you everybody for coming. I will do a slightly different format today, so hopefully everybody who's watching this stream either live right now or on the restream, I am looking for some feedback. So make sure that you do leave some comments in the comment section, or if you're watching it on the rebroadcast, go ahead and leave a comment in the comment section. So we are still going to do the normal Q&As. We do both a submitted question Q&A, so you can get those in on Monday, and then for the Friday episode, I will answer. Probably I've been doing all of them, but I'll probably cut it back down and select the best 3 or 4 out of them. And then of course, rapid fire Q&A through the chat section as well. So make sure you submit your questions now in the chat section. Don't send any money, don't super chat. Everything here is free, but definitely give a like for the video and we will get started. So what we're gonna do today, this is a little bit different. I'm gonna try a new format. We'll see if everybody likes it. Might be kind of enjoyable, might be kind of fun in the future. I wouldn't say I'm going to roast TikTokers because I'm not actually a mean person, and everybody's, I'm sure, trying their best, even though some of those TikToks we've seen, they're pretty cringe. But I'm going to play a couple of TikToks, and I'm basically just going to break down where they went wrong and hopefully give a little bit of a lesson so people aren't getting their investment advice from TikTok. That's probably not a very good idea. So we will do that. And then, of course, as a former professional golfer, I do like to try to tie in the fact that there are a lot of life lessons that I learned through golf that do actually apply pretty well to investing as well. So we'll do a lessons from the links. We'll do a couple segments. I will try to keep them pretty quick, and then we will get into the questions. So submit those now. I have to admit, I'm a little bit tired today. Usually I go running, but today I actually went golfing. So probably my second game in about a year. The last time I played was last summer, and I've kind of forgot how tiring golf actually is, especially in the heat. So took a cold shower. I'm ready to go. Got myself a strong coffee. Let's get started. Okay, so like I said, we are going to start in with some TikTok videos. Now, I did a little bit of testing with the live stream. I've never done this before, playing other people's videos. I've checked it all out. Apparently, it's on the up and up. None of them ever use any copyrighted music. As long as you give a shout out to whoever's video it is, and I will also leave links to their TikTok channels. I'm not even on TikTok, but I will find a way to leave a link for these people's. But I do actually have to hold my microphone, point it down to the computer when I'm playing these. So hopefully you can't hear that. I think it's okay. It shouldn't be popping in your ear, but I have to direct it down so we can listen to these. So let's go to a screen share and let's get started. So like I said, these are going to be dividend stock related, but let's just jump into this.
We need to talk about this. Last year, I made $20,000 in dividends. That's money that I didn't work for, money that just showed up in my bank account without me having to do anything for it. Now, I'm going to share with you how you can do it too. Dividends are when a company shares.
Those are the parts that I always like. When people talk about dividends, it's just like this free money arrived and you didn't do anything for it and boom, you're rich all of a sudden. And a lot of the self-made millionaires talk about how they did it through getting all these free dividends that just fall out of the sky, apparently.
Shares their profits with their owners, and you can start getting paid just by owning the right stocks. Instead of buying stock in one company hoping that they do well, you can invest in something called the Dividend Aristocrats or the Dividend Kings. These are companies that have been increasing their dividend or how much money they pay to you over the last few decades. Now, if you are early on in your investing journey, it usually makes sense to reinvest your dividends instead of spending them because they will start out small, but the more you reinvest them, the more they will compound and grow for you and make you more free money. Take our free investing masterclass to learn more.
Who doesn't love free money? I want some free money. Everybody gets free money. So all you have to do is buy dividend stocks. Let's do another one here.
Just launched a fund that's outperformed the stock market by 170% over the last day.
Sorry, I have to stop this. Kind of a pet peeve of mine, actually. For some reason, this word fund gets thrown around a lot there, but the word fund actually has a definition in the financial industry. It does apply. It implies that you are a registered advisor acting as a custodian for people's money. Everybody with a strategy or a portfolio basically just calls it a fund for some reason. And you also hear that thing hedge fund gets thrown around a lot as well. No, you don't have a hedge fund. You just have a portfolio of strategies. Hedge fund is a legal definition. You have to actually jump through a lot of regulatory hoops to be deemed a hedge fund. It is not something that's just some dude with a portfolio is a hedge fund manager. But anyway, let's continue.
Decade and 28% during 2022 alone. This is how it works. These are the rules.
All right, stop. No, you didn't outperform the S&P. This person has not made a single dollar with this strategy. Unfortunately, this is just called a back test. All they have done with perfect 2020 hindsight, they've just punched some numbers into a computer. And of course, if you had a DeLorean, if you had a time machine, maybe you could go back 10 or 15 years and make a few dollars off this. But no, unfortunately, this is just a back test and no actual money has been made. There's no outperformance of the S&P 500. Give me 10 minutes, I could make a back test that looks way better than this.
Of the algorithm. It only selects stocks from the S&P 500 for obvious reasons. It will buy a stock if its forward dividend yield is above 3% and its 5-year dividend compounded annual growth rate is above 10%. Both of these have to be true. But it will sell that stock if its forward dividend yield drops below 1% or its 5-year dividend compounded annual growth rate drops below 5%. Either of those things can happen and it will sell the stock. It rebalances every 8 weeks. These are the holdings that are inside of it right now. Its correlation to the S&P, its risk score, things of that nature. If you want to invest your own money like I just did, go to our profile and click right here.
Okay, so we're starting out this social media fails thing pretty tame there. I don't think there's anything horrendously egregious, but no, there's some massive misunderstandings in the TikTok world about what is happening when dividends are being paid. For some reason, there is this pervasive idea that it is somehow free money, like you didn't have the money before. All you had was this underlying stock that pays a dividend. And then on dividend day, suddenly you make money, right? Suddenly your net worth grows by whatever the amount of the dividend, or your net liquidation value in your account grows by that dividend. So I think it would probably be a good idea to just try to explain to people what is actually happening when you get a dividend. Because the truth is, the entire transaction is done at net zero. No money is made when you get a dividend, but we'll go through it. So here's a basic example. We got stock XYZ is trading at $100. What ends up happening is the stock will announce a dividend a few weeks in advance so everybody knows it's coming. Maybe 2 weeks ahead, they say we're going to pay a $1 dividend. Okay, X dividend date comes. This is the date where everybody holding the stock on that date or before at any time is going to get the dividend. So if somebody held it consistently for 10 years, they will get the dollar. If somebody bought it that same day on the X dividend date, they also get the dollar. What ends up happening here, this is the step people seem to forget about. But the stock is adjusted by the dividend amount. So this stock XYZ will pay a $1 dividend, and then the stock gets adjusted downward $1, and the stock is trading at $99. So that's essentially what's happening. Now, of course, during this entire process, this is a free market, and the stock can go up and down based on the market dynamics of buyers and sellers. But it is very important to notice what has happened here is that you have a cash disbursement of $1 that has entered your account. So that is extra money. Your cash value in your account will be $1 higher when you get that dividend. What people don't seem to focus on, though, is that the shares that you're holding are also dropped down by $1. Because, of course, what has happened at the company? Well, the company hasn't fundamentally changed overnight. Everything is the same, except their book value is now $1 less because they just gave a cash disbursement. So they have less money. This whole thing is done at a net zero transaction. So the dividend being paid didn't actually make that TikTok lady 20,000 free dollars like she's saying. This is not money that's falling from the sky. This is a very common process that happens. We can even take a look at what's happening here. Let's take a look at Coca-Cola, for example. Coca-Cola has announced a dividend of 46 cents, and this will happen ex-dividend date on March 16th. So anybody who holds Coca-Cola on March 16th or before, and remember, you can buy it on March 16th to get your 46 cents if you want to, and you will get it. There's no rule. You can hold it for one day and then sell it the next day if you want. But it is very important to understand what's happening here. If you look at the stock price recently, It opens at 59. It's got a high, a low, and a close. Notice how the adjusted close is the same as the close, right? That's, of course, there's been no corporate actions, so the adjusted close is going to be the same. But what happens when we go look at the last dividend? Well, the stock opened at 62.52. It has a high, it has a low. It closed at the end of the day at 62.48. And then they paid a dividend. That's the ex-dividend date. Well, what happens when they pay a dividend? As I said, that 62.48 gets deducted by the 44-cent dividend, doesn't it? Because the company has a book value that's worth less after paying a dividend. 62.04 is what the stock should be worth starting the next day. Well, look at the adjusted close, 62.04. That's what happens when dividends get paid. So this process that everybody on TikTok will tell you that free money has just entered your account and suddenly from today to tomorrow, your net worth, I guess, is 44 cents higher. And over the course of a year, if you have a large dividend portfolio, people actually think they're just getting this free cash. Nothing has happened. All that has happened is that your cash line on your brokerage statement, it will have a little bit of extra cash. And the, share value line, your unrealized gains, will be lower by the exact same amount. Nothing has happened. You are just, and this would be more obvious if it was a very large, like special dividend or something, then you'd be able to see it. You didn't suddenly just get richer by 20%. Sometimes special dividends are quite large, but no, that is actually not what's happening. Now, I don't want to say right now that there would be no reason to ever buy dividend stocks. That's not my point. My point is only that the transaction is net zero. But if you want to be a dividend investor for different reasons, I'll go over a few reasons why people might still want to buy dividend stocks, but not for the free money, because there is no free money. I want to stress that a million times. TikTokers, please stop talking about how this money just fell into your account. It certainly did not. Anyway, the first reason would be if you actually did value that income stream, because that's all that's happening. You're just getting cash and you're trading share value for that cash. Now, you could also do this yourself on a stock that doesn't pay a dividend. You could just hold the stock long term, and every 3 months, you could just siphon a few of your shares off and you could pay your own dividend. It's the exact same thing. As long as you're holding the stock for longer than a certain period, you're going to be deemed long-term capital gains, and it's going to be the exact same thing as dividends. Because remember, hopefully they are preferred dividends for long-term capital gains, but you are paying taxes on that cash stream, including the dividend that did not fall free money into your account. But that might be a reason. If you actually valued the cash, you could either do it yourself on a non-dividend stock, or you could just buy a bunch of dividend stocks that do give you that cash disbursement. It's, cut out the middleman, but it's actually the same thing value-wise. The second thing is, there is some research out there that might suggest that extra attention around those dividend dates might actually leave a little bit of residual value above and beyond. So remember this process. Starts at 100, they announce a dividend, it pays the dividend, it's adjusted down, and then the stock should be lower. But there is some research to show that added attention to the stock around dividend dates, because it is announced in advance, there might be a reason to believe that this $99 might be a little bit higher after the dividend is announced. It might be able to actually retain a little bit of that value. Now, I will also point out, though, that there is also research to show that that's not true. It's one of those things where it's not strong evidence. There is some if you look for it, but you could also find evidence to the contrary. So it is a reason, but maybe not a super solid one. The third one is, if you believe that the ability of a company to pay a dividend reflects a strong balance sheet, then that might be a reason to buy that company. Because of course they're going to need cash on hand, they're going to need to have retained earnings to pay dividends, and you might think that that reflects a strong company, especially with respect to what is called dividend aristocrats. So we can go a dividend aristocrat list here. There's currently 64. What a dividend aristocrat is they raised their dividends for 25 straight years. So that means not only did they continue paying it, remember the example for Coca-Cola paying 44 cents last year, now they're paying 46 cents. That is not only maintaining the dividend, but it is increasing it. Even just by 1 penny is good enough. But dividend aristocrats do need to maintain and increase it every single year. So there's 64 of these. General Dynamics just cracked the list. If you go to the top, 67 years, number one Dover. Pretty impressive, right? There's our Coca-Cola from our example, 60 years. They have raised their dividends every year consecutively for 60 years. So like I said, if you believe that that is actually reflecting a company with a strong balance sheet, then you could actually make a case that, okay, I'm going to buy this dividend stock because clearly they have a great balance sheet. Okay, fine, no argument. But what you also have to understand is, again, there is research showing that a company with a strong balance sheet that has been paying dividends for year in and year out and increasing them for 60 years, there's a lot of evidence to show that those are valued as long-term growth stocks. So the capital appreciation on the underlying stock probably isn't growing as fast as non-dividend paying companies that are just retaining that money within the company. And there's a lot of things. A dividend is only one way to potentially add share value long term. They could just keep that money. And they could just spend it on R&D within the company, and that would increase the share value long term. They could do a share buyback, and that would also be increasing share value. Dividends are not the only way to do this. They could use that cash and they could launch a new product line. Maybe that would be a better use of their cash instead of just giving it out in dividends. Maybe they could, there's all kinds of things that they could really do here. They could use it to buy other companies, buy out a couple of smaller companies if you're missing a few tech pieces in your major organization. So don't think that just because it's a strong balance sheet that suddenly means, oh, that's a great company. It might be a great, solid, sound company, but that also might be the same reason why it doesn't get valued as a growth stock. It gets valued as a value stock, which probably long-term will go lower. So anyway, last reason, again, this is there is some research to show that dividend stocks, especially if it's a significant dividend, like say 3%, something around that range, 3, 4, 5%, they might actually suffer lower drawdowns during market crashes due to what's called yield protection. So essentially, just to explain what a dividend is, let's say company XYZ trading at 100 pays a $5 dividend. How you calculate the dividend yield is, of course, very simple. You just take the dividend divided by the stock, and that is a 5% dividend. So everybody would say, oh, I own this company with a 5% dividend. But if the stock market crashes, that $5 dividend, especially if they're a dividend aristocrat, they have to keep that $5 dividend in place. They can't pull it away or they're going to be kicked off that list. So that $5 stays. But the stock price, if it goes down to 50, well, now all of a sudden you have a 10% dividend yield on this company. And presumably, external money is going to come in because that's an attractive yield compared to the S&P 500, compared to the bond yield, and probably dividend-paying stocks do suffer lower drawdowns because of that. So dividend yield protection might be another reason. But the whole point that I wanted to get across here, of course, we're roasting those TikTokers. Bottom line, it's kind of a pet peeve of mine again, but boy, there is a lot of misconceptions about dividend investing. And for some reason, people seem to think that the dividend itself is making the money. Another thing people think, which just isn't true, is that if you reinvest the dividends long term, that in itself is going to make you long-term money. It does not. It's the same thing. You can run the numbers. It is not free money. The only way a dividend stock will make you more money is if the stock itself appreciates in value. The dividend itself is done at net zero, so choose your companies wisely. Don't invest in something just because it pays a dividend. Like I said, you could get a growth stock that doesn't pay a dividend and pay yourself a much larger dividend if you're choosing the right stock. So, sorry, TikTok. Dividend investing is not the holy grail. It did not make you a millionaire. It did not make you any additional money whatsoever. That's not how it works. So next, I want to dive in a little bit to my golf career. We will keep it investing related, don't worry. But as a former professional golfer, obviously I do like to sneak in some golf analogies from time to time. Okay, so the next thing that we are going to review is what I want to talk about. This is more a concept of long-term investors, right? When you're looking for a strategy long-term, you're looking for a fund manager to manage your assets for you. There's that word again, fund manager. It means they're a registered advisor acting as a custodian for capital. Doesn't mean just some dude on TikTok has a strategy or a portfolio. But when people are out there looking for help with their investments, obviously they're not choosing things that are bad, right? I think that goes without saying. They're choosing things that either sound really good, or the manager says they've got a great track record, or perhaps you can even see some type of track record and there is some momentum. People tend to join when things are doing well. The other thing, though, they do tend to leave when things are not going well. And then investors sit back 20, 30 years later and they wonder why they haven't made any progress, right? They've seemingly chosen good managers. They've chosen good strategies. They can see performance and it looks fine, but then they look at their own account and they haven't made any progress. Now, of course, there's many reasons for that. I could do an entire live stream, just top 10 reasons why investors average about 2 to 3% long term, because the average investor, that's kind of what they make. It's pretty sad. But people often wonder why this is happening. I'm going to show you one reason why this is happening. It is not the only reason, but this is a very big reason. And I'm going to use my golf career as a backdrop, okay? So you'll get the point, don't worry. Even if you're not a golfer, you'll understand what I'm saying. So a professional golfer, their average scoring range is going to be about 60 to 80. So to use myself as an example, twice in competitive tournaments, I shot 61. That was my career low. I shot it twice. And the highest round I ever shot in a tournament was 78. Now, I never played like the British Open, the US Open. Get that 6-inch rough, get the wind blowing, probably I would have had a couple rounds in the 80s, right? So this is a pretty respectable range for a professional golfer, top 500 golfer in the world. 60 to 80, scoring average around 70. Your average club pro, right, just 5 or 6 of them at every golf course across the United States, has probably a range of about 70 to 90. They can play very well if they have everything firing on all cylinders, and they can easily shoot a 90 as well. So this player is just a decent club player. They might not even be the top 5 at their own club, but scoring average around 80, they're decent. Well, what you notice is if both of these players go out and play golf against each other on any given day, you will notice that this club player could actually beat this professional. It really could happen. Like, assume this is Rory McIlroy. Scoring average of 70, 60 to 80. Assume this guy is one of 10,000 golfers that have this range. Totally normal player. It is entirely possible that this player goes out and beats Rory. If Rory goes out and plays a bad round and he's over here, and this player goes out and plays good for himself and he's over here, guess what? He just beat one of the best players in the world. This happens all the time. Over one round, even over 2 or 3 rounds, this player can actually beat this one. But, of course, the way that averages work, the longer you stretch that out, that's no longer going to be the case. So you'll get to a point where over a 4-round tournament, and certainly over an entire season, it is literally impossible for this player to beat this player. It just would never mathematically happen. Even though on any given day or any given 2 or 3 days, yeah, it would happen actually more often than you think. But long term, that's never going to happen. So the point is, investing is actually the same thing. And what you imagine happening here, we're trying to avoid investors doing the dreaded buy high, sell low. But what will happen, and I'm going to use my trading as an example, this is our total portfolio solution, monthly distribution returns since we launched, and mine's been going live for over 11 years, so this goes back to January 2012. These are the monthly results. We do have bad periods. We do have losing months. We do have periods where nothing is working, and it's frustrating and whipsaw and can't believe it's not working. Is it broken? What's going on? This happens with all investors. There is no strategy and no asset manager that doesn't go through periods where their strategy isn't really conducive to the current market. That happens. This is the Vanguard VBinks. Same thing, monthly distribution. Again, losing months, winning months, everything is a little bit lower here. You can see that our 50th percentile is about 1.97, and the VBinks 50th is about 0.98. So my performance on a month-to-month basis is about double. But remember, when you overlap 2 things, as long as it's not mathematically like my worst month is better than the best month of this, which clearly is not the case, that means that even I, as somebody who has crushed my benchmark by 3 times since I launched, it is still possible for me to go through an extended period where I'm underperforming it. Just mathematically, it's going to work out that way. So this is the point. What happens when an investor is in a strategy that is a good strategy, but it stops working for a short period of time. They leave. It goes down. They lock in their losses, right? And then what do? They look out into the investment world and they try to find something that's doing well. They're chasing momentum. Oh, that one's doing really well right now. Let's leave this garbage one that's broken. Let's go over to that really good one. Well, what happens? Even if that other strategy is good, which is a big if in the investment world, as we know, 85% of asset managers underperform their benchmark. So it's probably not that good to begin with. It's just going through a short-term period of success. But let's assume that it is really good. It's also going to have periods of bad performance. So you have left something good to go over to something that's also good, but it's doing really well. So what's inevitably going to happen? Well, that doesn't last forever, so that's going to go down. Then you're going to move your capital over to something with momentum, and you're going to lose money over there. And then when that goes down to a point where you think, oh, I made a mistake. This was bad. It's not as good as I thought it was. Now you move your money out of that. But you didn't move it when it was doing well. You'd moved it when it was doing badly. This is what we do. We don't leave something that's doing well, and we always go to something that's doing well. So what's happening long term? Well, these people are just cycling through advisors. They're cycling through different investment strategies every 2 or 3 years or every year. And all they're doing is buying high and selling low. They're just waiting until their money goes down, moving into something that's doing well. That new thing is going to go down. They're going to wait till they go down. Then they're going to move to something new. And 30 years later, you made no money. Even though if you were to do an accounting of all the strategies that you left along the way, you're probably going to look back and go, oh, wow, I did just leave that one when it was just in a short-term trough. And yeah, I did go chase that one when it was at a short-term peak. That's what's happening. So these investors, you think it's crazy, but the average investor really doesn't make much more than 2 or 3% a year long-term. That's their annual return. And you think, well, how is that even possible? Just buy and hold the S&P and you're going to make 6 or 7, and then mix in some bonds, you'll make another, 5 and average it out. You might make 5 or 6. How's it possible they're making 2 to 3? Well, human nature, that's what's happening. You're leaving everything that isn't working short term, and you're going to things that are working. This is a recipe for disaster. So what you need to do, of course, is assess, is what you're following actually good? If it is, it does actually require that you stay the course. If it's not good, then get out of it, of course. This is not telling you to stay with your advisor just because it's going badly. If there's no reason to believe that where your money is being invested right now isn't good, then leave it, of course. But if you are convinced that what you are invested in is actually good, I'm sorry, you just have to stay the course. You're going to end up being like these golfers who the really bad golfer sometimes is going to show up and look really good, and he's actually going to beat this guy. But your money should have been on this one the whole time, because that's what the law of averages and long-term track records prove. This is where your money should be. I actually should have added another chart here, but even the great Warren Buffett, right? Everybody shows Warren Buffett's performance. Would it surprise you to know that Berkshire Hathaway has had several 50% or more drawdowns along the way? Well, how come everybody looks back right now and says, gee, I wish I just invested in Berkshire and just left my money there? Well, if you do that, it would have required you to maintain the course during a 50% drawdown. But probably a lot of those investors said, this is broken, I'm getting off the train, and that thing over there looks great. And then what ended up happening? The thing over there stopped working, and this Berkshire thing that looked disastrous, it ended up recovering. And then you look back 30 years later and say, if only, right? If only I just kept my money in Berkshire. That's what people end up doing. So don't fall into this trap. It's really tough. It's one of those investor psychology things that a lot of people don't see it when they're in it, and they don't notice it when they're doing it. But that's what I'm here for. Sometimes to let you know it is possible that what you're in that's not working is actually pretty good. And it's possible that what you are in that is working, it's possible it's garbage. So you really do have to assess those strategies. Everything has good and bad periods. So there's no way to avoid that. All right. So let's go to maybe 3 of the submitted questions. So I want to remind everybody, these submitted questions, let's close a few of these windows. Let's get rid of these TikTokers. Oh, that's another thing really quickly for those of you watching and for those of you on the rebroadcast, because I know many, many more people can't catch it live, but they come back. If you see some funny TikTok videos, maybe we can make this a weekly thing. Those ones were pretty benign. Like I said, they weren't totally egregious, but I know we've all seen some horrible ones. So go ahead and email me some, and sometimes we might just have to out and out roast them. I'm a pretty nice guy. Like, I didn't mention the girl, but look, I'm just being honest. If your investing guru is in a gray sweatsuit sitting on the floor, it's pretty decent chance she just exists on TikTok. But if you do see some TikTok investing videos that you just think are completely egregious and hilarious, email me. It's volatilitytradingstrategies@hotmail.com. Email me the clip, and maybe we'll make this a weekly series, because TikTok is an absolute nightmare, and there is so much hilariously bad information on there. But like I was saying, if you want to submit your questions early, every week on my YouTube channel here, you can go to this community tab, and I will submit the next live stream date, and below it you can actually submit some questions. So let's dive into a few of these. All right. Get some coffee. Okay, so Zach asks, could you talk about your early history in investing? What things did you try that didn't work? How did you discover volatility-based trading? What motivated you to create the volatility barometer? Are there other avenues of investing besides volatility that you feel you could have worked if you tried them? Okay, a lot of questions there. Let's start with unpacking some of these. So my early history of investing, I've told this many times before, but I don't mind sharing it again. I retired from professional golf in 2005, and I started trading. So I had a small amount of capital after golf. I was not a wealthy golfer. I, of course, was not successful. I ended up retiring. So I had a little bit of money, but not a whole lot of money. And so I just started trading my own money, thinking that, don't really know exactly what I'm going to do. But I ended up doing that for about 6 years, basically no job, no income, just trading my own money. And that's oftentimes why I'm so critical of the full-time trader lifestyle, because unless you're extremely well capitalized and unless you're actually a very good investor, 99% of people are just going to fail. That money is just going to be withdrawn from the account, and it's going to bleed down. Mine didn't, because I was making an abnormally high return. I was a risk taker more than I am now back then. And it worked. For several years, it worked. But I was one of those people, like I said before, you need to assess what you're doing. And sometimes it's really difficult to do that when something's working. It's very difficult to look at something that's making you a lot of money and you're making high percentage returns, and to actually look at it and say, you know what, this isn't sustainable. What most people need is to actually lose their money before they realize that. And then they'll go back and say, oh, I see. Yeah, I had blind spots all over the place. I couldn't believe it. But it's actually a very difficult thing to take something when you're doing well and realize this is not going to work out for me. And I was fortunate to be one of those people that saw it kind of before it happened. So I knew that I had to do something else. And then it led me into the VTS thing. I started publishing my performance online. That started about late 2008. And a lot of people started emailing me and asking for the trade signals to be sent to them. Just super basic. I didn't even have a website back then. People were just like, email me trade signals, an hour before you're going to take them, I'll send you $50. And I was doing it all through PayPal. And that's how this whole thing started. The reason you're watching me right now, because, 12 years ago, people were asking me to send them the signals before. So, if you're good at investing, wouldn't be a bad idea to post your results online, explain what you're doing, be accountable to those results. You never know where it's going to go. But that's basically how I started. So I did do some things that didn't work, but I was a volatility and options trader right from the beginning. So I don't know if this is going to sound super arrogant, but for whatever reason, I didn't have a whole lot of things that failed that early on. The only things that I did that ever failed was I went through a period in my life where, for whatever reason, probably because I was living in Taiwan, I was exposed to the Chinese market a little bit more. I got it into my head around 2009 that Chinese companies were going to kind of be the future. I wasn't wrong. I was just early. It was one of those things that's considered wrong as well. I mean, being early, you can lose just as much money. And so that's really the only thing that I ever did that didn't work for me is I invested quite a bit of money for about a year of my life in, Chinese companies that ended up doing quite poorly, even worse than other companies in the financial crisis. So that portion of my money didn't do well. But everything that I was doing with options and volatility, it kind of just always worked. I'm not sure if that's going to sound arrogant. I'm just being honest. So stock buying is what didn't work for me. How did I discover it? This was, again, I can't put my finger on why. I just immediately started trading options and volatility related strategies. I didn't go through a period where I was buying, risky AMC stuff or trying to buy Apple stock. I guess I wish I did. I bought Apple in 2002, I think, like early 2002, just because I loved my iPod, and it nearly quadrupled for me in price, and I sold it and I never bought it again. So it might sound great, and it was great for me at the time. I made a lot of money. But I mean, obviously it's gone up probably 100 times since then. So me making 4 times my money is kind of stupid. But no, I was options right from the start. So I don't know why. Maybe just I'm an analytical person. I like to have really true ways where I can be right and wrong. And I find with stock investing, there's always a way to move the goalpost. There's always a way to say that, no, it wasn't me. It was the market. It was this, it was the corporate announcements, it was a bad earnings season, whatever it is. There's always a way to do that. But with options trading, you are kind of able to define everything, and you are either right or wrong, and you just manage your trades that way. So it just appealed to me a lot more. What motivated me to create the Volatility Barometer, simply put, everything else out there is garbage. So I knew that I had to create my own. Like the VIX index is terrible. You can't base any trading off the VIX index. So what I did is early on, I started to notice some of these things. These aren't all of them, but some things like the volatility risk premium, for example, like the VIX index, like the implied volatility in certain option markets and skew and whatnot. Started to notice that, well, if you start percentile ranking these things, they can actually be much more useful than the VIX. So what I did is I just put as many as I could together and started testing. And over a period of 3-4 years, I came up with my volatility barometer, which is now what I consider, this is of course biased because it's my own creation, but I think this is by far the best measure of true market volatility. It takes into account so many different metrics over several different time frames. So I created this out of a need to do it. The market didn't have what I need in order to priority rank all of my signals. So that's what I did. I went ahead and I created it. It didn't happen right away, but it is now. And like I said, it works extremely well in dividing the market. See, this is another one. Are there different avenues that I could have gone to that would have worked? Nobody wants to hear me rant again about technical analysis and how that doesn't work. Seasonality doesn't work. Not really. I mean, to be honest, I view volatility as just a fundamental part of the market, and everything kind of goes through the volatility lens in some capacity anyway. So I just think that that's probably the best thing to do. Now, the vast majority of the investment world, they are just buy and hold pie charts, putting assets together in the same portfolio, working out those correlations and kind of hoping for the best. That's just not going to work, right? And so what else is there? Well, there's tactical investing. There's what I do. You could loosely call it volatility targeting, but we don't just reduce exposure during high volatility. We exit completely out. We move to different assets. And then I have a ton of option trading as well in my portfolio. But there really isn't anything else. I mean, that's a good question. What else? If I could just go back in time and say, volatility's off the table, let's go down a totally different route and see where we can find. What would I do? I mean, that takes options trading off the table. That takes volatility ETFs off the table. That takes my volatility targeting with my main strategies off the table. What else is there? I don't even know. I know there is. I mean, I could go on Twitter and I could find people who say, no, this is the way to do it. Like technical analysis. A lot of people actually believe that drawing their lines and their patterns and their flags on their chart is giving them information. I don't know. I disagree, but people are free to do what they want. So that's how this is where I ended up. I don't know. I don't know if that sounded good or bad. I just never really had any other reason to question what I was doing. Options and volatility all the way. 17 years now. It's still working great. Okay. Challenge. If you would have to come up with an option strategy which realistically returns 40 or 50% a year, what would be your best try? Of course, only with YOLO money, very small capital for fun. What would be a good strategy? Why not? So, of course, I have to nitpick a little bit here and say that this last part, I know this is part of the challenge, and so I'll play along and I'll take the challenge. But just know that for me personally, this is a non-starter, right? If you just simply run the math on it, making a large return on a very small portion of your money doesn't really push your portfolio forward very well. I always say what we're trying to do in the volatility space, we're not trying to sell, all these people that talk about selling naked calls on UVXY, you know what they're really doing? What they're actually doing is they're not totally stupid, right? They're not the smartest people in the world, but they're not totally stupid. They know that it's going to blow up in their face at some point. So what do? They use maybe a fourth or a fifth of their capital for the actual trade, and they just leave the rest in cash to defend the position if it goes against them, because they know at some point it's going to go against them. For some reason, these people have not run the math on the very simple concept that every time you have an easy win, that's only 1/5 of your money. Every time you have a disastrous loss, that's because you used up all the layers in your portfolio and had to shut things down. So what kind of long-term strategy is that? To divide your capital so you're doing something extremely risky, but only on a very small sliver of your capital. And then you have all these other layers to come in and fix it when it breaks. So you're going to get, because it's a short vol trade, you're going to get weeks and weeks of easy wins. You could go on Twitter every week and say, yeah, I did it again. My vertical expired again, in the money, I get everything. Great. Easy win. Next week, easy win. Next week, max profit, max profit. You keep going. But what they're not telling you on Twitter is you're making max profit on a tiny sliver of your portfolio. That's not helping you. All of your wins are nothing, and all of your losses are disastrous. What kind of long-term strategy is this? It's totally silly. So that last part, I know I'm nitpicking, but the goal of a trader is always to get the most amount of your capital working for you as you possibly can and make sure it's safe. Making a 10% return on 25% of your portfolio is going to be better than making a 40% return, like you said, on 5% of your capital. Just run the numbers. Obviously, making more money on that portion is going to be better long term. It just works out that way. So I don't do this thing. I don't say, oh, it's okay. It's 5% of my portfolio. I'll try to make 40 or 50 on it. What's the point? Why wouldn't I just focus on having a 20% sliver, like which our portfolio is? Why wouldn't I try to have 100% of my money allocated into strategies that can all do well? Why would I want to take this piece, divide it into a 5% YOLO slice, and say, let's try to make 50? Well, why don't I just take the whole 20% and try to make 20%? That's going to be better for me long term, isn't it? So again, nitpicking your question, I know in the spirit of this, you're just asking me, what would I do? Well, for me personally, my two most profitable strategies are, number one, I guess monetarily, money-wise, since about 2012. Number one is just trading the volatility ETFs. Short vol, long vol, basically percentile ranking, volatility targeting, and making sure that I'm short vol in those inverse funds at the right times, roughly 40% of trading days in a year, and then long volatility, roughly 2 to 3% of trading days in a year, and 55% of the time in cash, just all 100% in cash. You're either 100% short vol during those really strong trends, or you're 100% long vol during only the strongest market crashes. Everything else you're in cash. That strategy has made me so far about 50% a year. Now you could argue, because I'm always the one that says, well, are you talking about 10 years or 30 years? Because it has been pretty advantageous for the short vol trade, hasn't it? So someone like me who makes 50% with that strategy, well, I don't know. I mean, is it going to keep going? That's an obscene rate of return. It's probably not going to be sustainable, is it? Something's going to happen. The market's going to normalize in some way. I'm not just going to make 50% forever. That's not how trading works. So yeah, it's been a pretty advantageous period for the short vol trade since about 2010 certainly, and we'll see. It hasn't done overly well the last 3 years. Maybe this is just a short-term hiccup. Maybe we have to all reduce our expectations down to 15, 20. That number that I always say is fantastic. If you can make 15 or 20 a year, boy, you're world class. So that's the first thing. The second one is my VIX options. So I put roughly 25% of my own personal capital into my VIX option strategy. Typically is straddles, diagonals, iron condors, things like that on the VIX index, mostly straddles though. And that strategy has made me about 25% a year since 2011. So probably I would just ramp that up. I'm not interested in the YOLO. If I was YOLOing, all that you're doing is you're leveraging your beta, basically. You're just, during good market periods, you'll make a whole bunch of money because you're taking leveraged, risky positions. And then when the market doesn't cooperate, you're going to crash and burn. Nothing risk return wise should be making that much money. If it is, you could be an all-star trader, but you should also consider that it might not last forever. So sorry if I didn't completely answer your question. I just really don't do this. Again, if you want to make the most money long-term, you need to get as much of your money working for you at all times. You don't sell naked calls keeping 75% of your money on the sidelines. Just run the basic numbers in your head for that type of strategy. Every win is tiny and every loss is costly. Boy, I can't believe there's people who do that, but they are. Mostly probably just exist on Twitter. Nobody's actually showing a track record of that, thankfully. But yeah, people sell that kind of thing. They say, oh, it's fine. Just leave 3 or 4 layers on the sidelines to defend it. Cool. That's brilliant math. That's awesome. Okay, enough negativity. Let's focus. Could you talk about placing VIX calendar spreads and what you're looking for? I don't actually trade calendars on the VIX. Not that you couldn't. It's just that I typically default to straddles, occasionally iron condors, like I said, diagonals occasionally as well. And the only reason diagonals, to be honest, is there are times when, because you're staggering both price and monthly expiration, I wouldn't say there's some free premium there, but just sometimes based on the way the premiums are bouncing around, there is a little bit of an arbitrage there. I've actually created risk-free diagonals before on the VIX. It's not a normal thing, and it's not something you should be dedicating serious time to trying to find, but it does happen. Sometimes the premiums just land that way. But I don't do calendars. But what I would be looking for, if you're talking about the VIX index, I mean, a calendar is essentially a market neutral strategy. So you'd be looking at the same things as anything else. You'd be looking at periods where, for whatever reason, you have a system, hopefully, you have a timing mechanism, you are not expecting the VIX to deviate too far. So you could throw out, the VIX is 1882 right now. Remember, the VIX settles to the front month VIX futures. So we'll use 20 as the number, not the VIX at 18, but at 20. Okay. If you thought that a month out that the VIX would not deviate a whole lot from 20, yeah, you could or you could buy a calendar on the VIX, and you would probably want to hedge it. So, I mean, if you were looking for something, you could say, let's move this out of the way. What month would be good? Let's just do this one, just for the heck of it. So let's say you want to lead lower. So you're going to do a 19 calendar. There would be nothing wrong with this trade, right? This is a calendar on the VIX. Remember, calendars sometimes they look really, really bad depending on the way that the premiums land, but you are just looking at the pink line. This turquoise line, this is expiration, and you would not let them go to expiration. So sure, you could do this. There's your price right now. That's your front month VIX future. This pink line will probably make you money as long as the VIX doesn't go crazy. As long as everything's kind of stable, you're going to make your positive theta every day. Probably that's a bad print. It gave me 42. It's probably, you can see it's not zeroed out there. So anyway, this should be, if you were actually trading it live, you probably wouldn't get this price. You'd probably have to get something like that. maybe 43-ish, like that. And then, yeah, you're just looking to collect every day. You're just going to collect a little bit of money, and that's it. If it spikes, you might obviously want to buy some type of single high-end call. 36 would be too much money. Something like this, just to be safe, just in case. Well out of the money. Make sure you're not burning, of course, all of your premium there, but these are fine, right? VIX doesn't tend to crash downward, especially since it's been crashing. It's probably not going to continue down crashing. So you are actually worried about the high side. You probably want to throw out that long dated call or the furthest out of the money call, something like that. But bottom line for your question, VIX calendars, it's a delta neutral trade. So whatever you would do to open a delta neutral trade, that's what you would be looking for with calendars. I don't particularly do it. I prefer straddles, but it's all the same. It's a delta neutral trade. I just like the way they trade better. I like to be really short vol. And of course, a calendar has both a long and a short, so it does reduce that vega a lot. I prefer to take on that short vega. All right. Last one, I suppose. Cost. Oh, yeah, I read this one ahead of time. So this is really quick. This will be 30 seconds. The cost of trading VXX on Schwab is very high, about $1.30 per contract. Is there another broker that does not charge per contract for options? Or is there another volatility ETF instead of VXX that we can use with lower costs? So you're facing two issues here. Of course, you nailed the first one. $1.30 is obscene. You need to switch brokers. I don't know. I can't tell you what to do. I can't tell you which one to go to. I personally use Interactive Brokers. And for this live stream account that you just saw, that's Thinkorswim. So I have a little bit of money there as well, so we can execute some trades. But I use Interactive Brokers. And they, of course, almost all brokers do charge per contract for options. But it really should be less than 50 cents per contract. If you're paying more than 50 cents, you're paying too much. Probably move brokers. The second problem is that the VXX has not reverse split yet, so it's a very low price. UVXY is under 5. This is not helping traders. Of course, you're going to have more contracts the lower it is, and a reverse split would be very helpful for us option traders. But yeah, if Schwab, that's obscene. $1.30 per contract. Wow, I've never even heard of something that bad. So move brokers. All right. Let's go through the chat section. Wow, I'm sleepy. Yeah, let's go through the chat section. Let's get to some of these questions. So again, you can submit whatever you want, and we will try to get through some of these quickly. So did you ever think about speaking at trading conferences and showcasing VTS to others? Maybe. Yeah, maybe. I mean, I would not be opposed to doing that. I think the main headwind to something like that would be that I'm sure you can probably imagine that I'm not actually in the financial industry, and I am a very big threat to people who are in the financial industry. And I don't just mean me directly. I mean people like me who have decided that, look, if asset managers, if 85% of them are going to be pretty garbage at their job, well, why don't I just offer something that is better performance at a cheaper price, and I can do it for everybody around the world instead of just my jurisdiction? So there's not going to be a whole lot of asset managers out there that are looking to help me out, if that makes any sense to you. I don't know how else to say it, but my model is basically the way that I imagine it. Like, take your average asset manager. If I forwarded that asset manager's performance, their website, their YouTube channel to my entire community, and I said, that guy in Chicago is an asset manager, go check out his stuff, I would imagine I would get pretty close to 0 people